Hey guys, thanks for joining us for another video here at Lewisburg Investments. We thought it'd be a good idea to walk everyone through our security selection process, which is just a fancy way of saying, how we go through and choose the stocks and bonds that find their way into our portfolios. And we wanted to do that walking through a recent investment decision we've made, which is the investment in Alibaba Group in our international fund. I have with me Daniel Robichaud, who is the portfolio manager for the international fund. So he's going to really walk us through why we thought this was a business that should be included in our portfolio. And we'll do that through going through the four pillars that we use when we look at every company here at Lewisburg Investments. So we have business model, financial condition, outlook, and valuation. Why don't you tell us why these are pillars that are really important to us and how we use them in the investment decision process?
Yeah, really those four pillars, all our investment process revolve around those. The first one is the business model. And when we think about it, we typically break it down in three. The first one is really we want to understand what does the business do. Is it attractive? So really we're going to go from how they generate revenue, who are their customers, what in the industry, what are their market share, the prospects. And we want to know everything around that business. And that's the only way you can start the research report. If you don't understand all the moving parts, really you can't move further down. I think that's the key to start here. Then we move to track record or financial track record. And what we want to do is look at the long history of their performance and confirm and what we thought about the business. So really, we think the business is attractive, good industry. Does that show into their financial results? And that tells us a story. We're going to see the margin, all the key performance metrics, and that's the way to confirm and learn more about the business also. And then if we look at those two other parts, we like the business, they got good track record that confirm this. We want to think around like why have they been that successful, and why does that company create that much value, and is that sustainable in the future? Is there any disruption risk? So that's kind of the last bucket of asking a question. We want to make sure that they can keep generating the same value they did in the past. So that's kind of the first pillar. Then we move on to balance sheet. The balance sheet sometimes can be short and long, or sometimes it can be more long because some of the companies don't have any debt or very little amount of leverage, or sometimes they got a bit more leverage, and we want to think about all the different moving parts. The key is we don't want the company or management team to run their company in relationship to the balance sheet. So we want them to be focused on creating value for shareholders. The balance sheet should never be the issue to it. And so that's kind of the first two pillars, and I'd put them in the first bucket because we need to check the box if we want to move further. We are not going to invest in those companies if we cannot be confident about the business model and the balance sheet.
Yeah, those are the non-negotiables.
Exactly. So if we check the box on the two first pillars, we move to the second one, the second bucket, I'd say, which is outlook and valuation. Outlook is just a way of looking at what's the current operating environment for them, how the results has been, listening to the conference call, and we want to really understand how the current environment is for them. And then we move also kind of the medium and long-term outlook. What are the prospects? What do we see? Then we move on to valuation, and that we'll do it in multiple different ways. We do our long-term financial projections. We're going to have DCF, look at peer valuation, relative historical multiples, a bunch of different ways. And at the end, we want to basically see that bucket as a kind of a risk-reward proposition. And that's really about how much exposure we want to that company. So first one is, do we want to own that business? Second bucket, it's really about how do we find a risk-reward proposition attractive here and how much exposure we want here.
Yeah, so given we said that the business model and balance sheet are kind of the non-negotiables, I think that makes sense to start there. What really intrigued us first about Alibaba that made us want to actually do the deep dive? What really sparked our interest?
Yeah, so for listeners that don't know who is Alibaba, I think the easy way to look at it is kind of an Amazon but based in China. There's some nuance, and we'll talk further about it, but really the business started in '99 as a marketplace for the B2B market. So think about manufacturers, connecting manufacturers with wholesalers and businesses. So a good example could be, let's say Rouse wants to start his t-shirt business, and he's looking for a manufacturer. Doesn't need to make call or basically build his own infrastructure. He can just go on that marketplace and find a local manufacturer in China to provide him his t-shirt. The second marketplace that he expanded down after is the C2C market. So similar example, Rob got his t-shirt from the first Alibaba platform, or the B2B. We're moving to C2C. He's going to be selling his t-shirt on that marketplace to other consumers that are looking for that type of product. So really, it's connecting consumers to other consumers. And finally, they expanded to the B2C market, which is business selling to consumers. So you could have an example where Michael Kors could be putting their product, their purse for sales into that platform, and some way for Chinese consumers to be buying that product.
Yeah, so it sounds like the first one, the B2B, is pretty unique, but the C2C sounds almost like an eBay, and then it might be comparable.
Yep.
And then the B2C is a lot similar to what we typically associate with Amazon and stuff like that. It's not a good way to think about it.
Exactly.
So, I mean, these are all different types of marketplaces. It's a word that gets thrown around these days. What do we like about marketplaces? Why is that an attractive business for us?
Yeah, so really the first key is that's a very scalable business. And what we're seeing is if you scale them and you can create that network effect, it becomes really powerful. So here we've got kind of a two-way network effect. The more users that join the platform, the more businesses wants to be there. So as you add more and more business, well, consumers becoming more and more attracted to that platform. So you just create that network effect. It scale and scale and scale, and that becomes very valuable. All of that is done digitally, so obviously there's not a lot of extra cost for Alibaba. So once you build it and you get that network effect, those are very, very profitable.
Right. So, I mean, that sounds like we like the business quite a bit. But, the business operates in an industry. So what about the industry itself?
Yeah. So when you look at the Chinese market, we always think about retail transaction and how much online is in that market. In China, around 25% of transactions are done online. And that's really what we want to see, kind of online becoming a bigger part of retail transaction. It's actually more penetrated in China than in developed market, which could sound surprising in some ways. And I wouldn't make it, typically we wouldn't see that as positive, but the flip side is the Chinese retail market is growing a lot more faster than in the developed market. So the end result is we're gaining still more penetration, and the market's growing very rapidly, which has resulted in around 25% growth over the last 2-3 years. And we think there's a lot of years to come of double-digit growth still.
So can you compare that to what we see in more developed markets, maybe compare it to the U.S.? Like, what's the penetration there, and what would be the growth rate we've seen over the past few years?
So in U.S., you're probably looking at low double-digit growth, but the penetration rate is only in the low teens too.
Right, so both like 10 to 15% on both those numbers. Yeah, so it sounds like you've already got that more penetration, but we also have the population is huge and the economy is very large in China. So what does that mean for the market overall in terms of dollar value?
Yeah, the market is really big in China. So we're talking 1.5 trillion of retail transactions are done online. As example, it's more than 2 times the U.S. market.
Right. So yeah, obviously we love to see those big markets, and it seems like they have an attractive business. But how are they positioned relative to their peers? Maybe looking at more competitively in the industry, how it's made up.
So really, Alibaba is kind of the pioneer. They're kind of first mover advantage. They built that platform. They got the momentum, and they've been holding those market shares. So when you look at it, they're by far the largest platform, almost 60% market shares on the e-commerce retail transaction. And no one's really close to the same amount of market share. You got 2 other sizable players with G.com and Pinduoduo, but still way, way smaller than the Alibaba platform.
Right, and JD.com, I know that Walmart's got a sizable stake there, so obviously they're willing to put some cash behind that. Yet Alibaba is still able to maintain that leadership position, so that bodes well for them and what they've built. We know that Alibaba doesn't just do e-commerce, though. They're a part of a lot of other buckets, a lot of other industries. So what would be maybe the next business that investors look at and focus on?
Yeah, so I'd say the next biggest business in terms of revenue would be their cloud infrastructure. They started building that a decade ago. And what we're seeing there is really there's a big movement or big trend of enterprise moving from owning their IT hardware to outsourcing and moving to the cloud.
It'd be like us at Lewisburg, like we own a server here, and maybe we decide we don't want to buy servers anymore because they're really expensive, so we'll just pay like a company that does that here in North America, like AWS or Google.
Yeah, exactly.
To do that. Yeah,
exactly. You pay for your capacity you're using, basically. So kind of more recurring monthly, but not a big upfront payment and a big investment.
Yeah, and you can kind of scale up and down as you go.
Exactly. So when we look at Alibaba, again, they're the dominant player in that industry, around 45% market share. And when we think about the industry prospect in China overall, there's a huge opportunity. The level of IT spending is still relatively small relative to the size of the economy, and we see Chinese companies start to investing more there, but also we're seeing the amount of spending on cloud relative to the IT spending being really low relative to more developed markets. So kind of two different ways that they're going to keep growing in the future, and that's going to bring decades of growth for a company like Alibaba.
Yeah, it's good. We've already started to see in China a lot of these unicorns being formed there, so the investment is already starting to pick up. So that kind of confirms what you're saying. Does scale matter in the same way for this type of business as it does for e-commerce?
So the cloud infrastructure business has really proven to be kind of a scale game. So right now, everyone's is fighting to gain customers and building really a large amount of scale. Right now, we'll see Alibaba is still not profitable. They're adding those value-add services. They're still gaining new consumers and reinvesting everything in the business. But what we've seen, and when we look at more developed markets that are still growing really rapidly, but it's more mature than what we see in China, is in the US, you got the Amazon, Google, and Microsoft. Once you reach certain amount of scale, they start becoming quite profitable. And the other thing is, this is a pretty sticky business. Once you outsource, you don't want to be moving again to another provider. So I think a lot of good prospect on that segment.
Yeah, that makes sense. So obviously, we like that business for all the reasons you just discussed. We like the e-commerce business. But again, they do so many things. So we talked about number 1 and number 2. What about 3, 4, and 5? What other things? What other hands do they have? What other jars do they have their hands in? Sorry.
Yeah, so many things we could talk about. But overall, what we're seeing is Baba is taking a similar strategy than what Amazon's been doing and creating a whole ecosystem around their core commerce business. So they've been adding on the media and entertainment, so long form video, music, games. They've been adding different consumer services that could be food delivery, etc. And really what they're just creating that big ecosystem with a loyalty plan that's going to create a lot of user stickiness in the future.
Yeah, they're trying to give the consumer lots of excuses to go on their website and to go into their platform. Yeah, and that does that two-way network. Yeah. So we talked about the business model. Then we like the first part, like what and how. Sorry, like what they're actually doing and how they do it, and we like it all. It checks all the boxes. But when we look at their track record, does it confirm all those things that we just said?
Yeah. So track record is obviously quite impressive in terms of growth. We're seeing 45% revenue growth rate annually over the last 7-8 years. So quite impressive. It also tells us the story. We see the margin profile changing over time as the business mix is evolving. They're moving into all those different consumer services and other products. So it's been a really profitable business, and the track record is quite impressive overall.
And we talked a lot about their competitive positioning already, but how would you kind of summarize like how we feel comfortable in their competitive position and how we don't really see them being disrupted in the near future?
Yeah, so we've kind of just mentioned it a bit. It's all about scale, network effect, and now they're just building on that. They're creating that whole ecosystem and monetizing their user base that they have here. So that's obviously going to be tough to disrupt. I think brand matters also. They create that platform as example on the B2C side. In China, a big problem is knockoff products, but consumers know if they go on that platform on the B2C side, they know they're gonna actually get the product they want. They want that fancy watch. That's actually the product they're gonna get. So
you're saying the Rolex I bought it last year wasn't real? Is that what you're trying to tell me?
You can be sure when you buy it from that battle platform, you're gonna get the product you want. So I think that matters. But then what are the risks? Obviously, there's always different risks. I think one is what we're seeing in the U.S. Right now is as you become big and bigger, government will start to look more into your operation. I think so far Chinese government has been really supportive of its own or the really successful story in China. So far that haven't been an issue, but obviously it could become at some point. The other thing I could say, I guess, is that China relationship with other countries has been souring. Take example of the U.S. blacklisting many different Chinese companies. Take in that case, the core of the operations remains in China. They're expanding, but it's been in Asia. But at the end, most of the profits is all made in China, and there's a huge market opportunity right there. So I don't think it changed really the thesis here.
Yeah, no, that makes sense. So it feels like they're checking all of our boxes on the business model, but they're making lots of investments. I mean, we're talking about large IT infrastructure that people are outsourcing to them, and obviously that takes a lot of upfront capital, and then all the investments in entertainment, stuff like that.
Mm-hmm.
Have they had to take on a lot of leverage, and have they had to how are they financing all of this investment that they're making?
Yeah, so like we said, the core commerce is really scalable, and it's right now very, very profitable for them. So they've been reinvesting a lot of the cash flow into all those other businesses, but really the balance sheet remains really clean. They have a net cash position, so nothing to worry about. I think it's just a source of opportunity for them.
Right, so they've been really funding that internally without having to access capital markets and stuff like that. Yeah,
exactly.
So we feel like we can check that box too then.
Yep.
So we've got those non-negotiables down. What about the outlook? Are we just as positive on the outlook? I mean, obviously we've already touched on it several times on how we see those kind of secular tailwinds, but is there any kind of near-term issues that we're seeing or longer-term issues?
Yeah, so in the short term, we think those structural tailwinds are just accelerating. What we've seen with the pandemic is this has just been accelerating how consumers use online market. And what we're also seeing is enterprise are just looking for more flexibility at being more able to access virtually their IT software. So we're just seeing an acceleration in that shift that we were already seeing, and midterm, long term, no change. I think those are all industries that got very good prospects.
Yeah, e-commerce is going to keep growing, and retail sales in general in China are going to keep growing. Yes, we feel confident in that. Well, whenever we come across a business like this where we feel really excited about the business model, balance sheet's clean, and outlook is attractive, you got to pay nosebleed prices to be able to actually buy it. So valuation ends up being an issue for us. So how did we kind of overcome that and feel comfortable stepping in with the valuation we're seeing here?
Yeah. So I think one key is if you just look at the traditional metric that people would be looking, just kind of price to earnings, it does look expensive. But when you start breaking down all the businesses, all the different segments, all the money they're investing right now on businesses that are still not profitable, you start realizing you're not paying much for all those prospects. There's a lot of optionality in the portfolio. Like we said, the balance sheet is clean. They have a big stake in Ant Group, which is quite valuable, and we don't see any earnings really. So I think when you start breaking down all those businesses, and we do kind of long-term sum of the parts through a DCF there on all segments, we started to realize this is really cheap. There's actually a lot of growth, and we're not paying for it right now.
Right. So if you look at the actual e-commerce business itself, I mean, just kind of value that, and then look at all the other investments they're making separately, and associate different values with that. That's how you kind of come to seeing the real value in the business. Whereas if you were to just look at the consolidated numbers, it looks like because the profitability is being masked by these investments, there's really not a lot there. Is that a good way to summarize it?
Yeah, for sure. So I think that shows kind of the value we can add by really digging into all the business lines and thinking of all those moving parts long term.
So clearly we're excited about this business. I mean, it's already been a good performer for us since we introduced it. to the fund, and it checks all those boxes. So I hope this was helpful for all the listeners to kind of see the kind of work that we put into it, the process that we go through to actually decide if we're going to invest or not. So thanks so much for walking us through that.
No problem.
And I hope you guys enjoyed.